Welcome, everyone, to the NZ Everyday Investor. I'm your host, Darcy Ungaro, and I'm sitting in the studio today with Chris Tennent-Brown from ASB. Welcome, Chris.
Good morning. Thanks.
Yeah, thanks for coming in today. A nice, beautiful, rainy day, and a beautiful time in the markets. It's just fantastic, isn't it?
Yeah, it's a great day to ride a motorbike in and get wet right off the bat.
Yeah, that's right. And so thank you for coming in today. We're going to be covering a whole host of topics, mainly centered around, I guess, hey, there's a pin, there's a bubble. What happens when those two things meet? and we have what we have right now, where things are changing, very dynamic right now. Let's talk about this because it's going to be probably one of those evergreen sort of things where there'll always be these buildups of pressure, and then these kind of periods of time where that pressure is being released, and things change. So we're going to have just a general, broad discussion on that. But just for our audience, tell us a little bit about who you are and what you do.
Okay, well, I'm a senior economist at ASB.
Yeah.
I've been an economist there since the early 2000s. So my role really involves forecasting and understanding what's going on in the economy, and with a real focus on what that means for things like mortgage rates, term deposit rates, how KiwiSaver is going to perform. And in the last few years, my focus has been very much in that investment space. So cool. Understanding what's going on in the economy and what it means for investors.
Okay. And typically the format of what you do is what? Like in terms of what you produce with ASB, what do you generally put out there?
Well, I could do anything from talking at a client function with people about those things, explaining the low interest rate environment that we've been stuck in for a few years, through to writing the investment commentary that someone would receive if they subscribe to our research or if they were an ASB investor.
Yeah.
So really, it's like a glorified journalist in some ways.
Yeah.
There's a lot of stuff that goes on, and I try and understand it and explain what it means from the perspective of an investor or a saver or a borrower when it comes to those mortgage rates.
Now, we're recording this on the 20th of March, and stuff's going down. Stuff's going down faster than what most of us can get our heads around. So just to set the scene, tell me what's happening right now in markets.
Well, this has been a massive week of huge action from the Reserve Bank of New Zealand, from our government, and really that's been happening around the world as well. We've seen central banks cutting interest rates in between their regular meetings. We've seen governments swinging into action, both with controls about population movement and packages to try and support the economy and keep things going as well as they can. In New Zealand's case, a $12.1 billion package from the government is massive relative to the size of our economy. And the Reserve Bank's cut the official cash rate to a record low. Now they're looking at measures to provide liquidity into the market. So there's just so much going on. And being a little bit old, as people can probably tell by the grey hair, I have been in periods like this where markets are stressed and we're seeing central banks and governments swing into action. But it's all happened pretty quickly. Yeah. I mean, none of us had probably heard of coronavirus or COVID-19 a couple of months ago, and here we are with central banks redeploying tools that they used in the global financial crisis, and governments turning the taps on. So it's just a staggering week. And meanwhile, share markets, bond markets have been very volatile in both directions. We've had days where the share markets dropped by 10% or more overseas, and likewise days where it's bounced up by similar sorts of amounts. So it really is pretty amazing stuff.
It is, isn't it? Like the GFC, I guess, was kind of like a dry run, and things were kind of, cobbled together, kind of willy-nilly. Let's try and fight this thing. But it was kind of a progressive thing, and they were grabbing stuff as they went. Here, it's like they know kind of what tools are already available because they've used them once before. It feels like those tools are being implemented a lot quicker now. Is that true? Like, are they pretty quick to respond?
I think if you look back on the global financial crisis, Things were stretched. I mean, the housing market had been booming here. The official cash rate was at an incredibly high level to try and slow things down or cool things down. We had 8.25% official cash rate setting, and people thought, hey, well, how's this going to end up? But we didn't probably sit around and think, hey, well, it'll be the US housing market that starts to trigger off a whole lot of problems.
Yeah, we could see the bubble, but we couldn't see the pin yet.
Yeah, and we couldn't see what the issue. There were tensions. People were stretched by having mortgage rates that high in New Zealand, for example.
That's right.
But those problems gradually permeated through the system. I mean, I was working in New York when the banks really started to get stressed, and it was a peculiar week, as it turns out, to be working over there.
Yeah.
But these problems worked their way through the system, and first of all, there was stress within the financial system in the States, and then that flows through to confidence, that flows through to other markets, and ultimately it started impacting things like trade.
Yeah.
And then central banks had to swing into action, cutting interest rates, putting in liquidity measures to help people trade with each other, and governments swung into action. But some of the measures, if we look at things like redundancies and things like that, airlines having to really trim their workforces. Now, that happened well into the crisis. We look at it here, and we're 8 weeks in, and we're hearing things like the airlines having major restructuring, really within weeks of this all getting started.
Yeah.
We're seeing central banks have cut interest rates down to record low levels right at the start, and governments are talking about spending packages and doing whatever it takes right at the start.
Yeah, it's crazy. Yeah,
if we think of something like the global financial crisis that dragged out for a couple of years in the end. So this is very preemptive stuff.
It is, isn't it? Yeah.
And the other thing that's really different is part of the cure for the coronavirus is part of the problem here.
Yeah.
The problems were permeating through the financial system in the global financial crisis, and then spreading out into businesses, spreading out into trade. And governments were trying to respond. Essentially, they were trying to prop up demand with their expenditure. They were trying to prop up demand and access to money with those low interest rates. This time around, to cure the problem, coronavirus, we have to stop demand. We have to make people stay at home. We have to leave kids at home rather than going to school. And all these measures that'll fix the problem are causing the economic slowdown.
This isn't a virus of the economy necessarily, but it is.
Yeah.
Like it's a virus, but in a parallel reality, it's absolutely a virus, and the only way to beat it is to, what's the saying? Starve a flu, feed a cold?
Yeah, and I look at today and I'm riding to work. There is no real issue apart from it raining on our day-to-day business. But in the background, we've got this obvious and visible threat that we know we need to respond to.
Yeah.
So it's an amazing situation, and amazing how swiftly how swift the response has been, and how swiftly things have changed for us all.
That's right. Yeah. And I know for a lot of households, it's incredibly stressful right now. And some people have felt it right away. Other people are looking down their pipeline and seeing that there's a problem coming, and they're worrying about it, in a sense, almost too soon, because you're paying for it more than what you need to, because it hasn't happened yet. But you can sense that there's a lot of aggregate angst and pain and worry and anxiety out there, right?
Yeah, I mean, I think there's some irrational stuff like hoarding toilet paper that doesn't really make much sense to
You should be hoarding barrels of oil at least.
Yeah, well,
Wouldn't that be a wise move?
I thought making sure the wine rack was stocked in case I'm stuck at home for 2 weeks was important, and I had some sausages for the barbecue. But realistically, you're right. There's people that are getting impacted to varying degrees. For example, in our household, my partner's a flight attendant.
Is that right?
So her work is already impacted, and we've got a highly uncertain outlook for her earning power. The cats love it. They think if you're going to be home a bit more, that'll be neat.
Yeah.
But it might not look so good for the household cash flow.
Yeah.
So and of course there's people that are impacted through travel restrictions, and tragically it hasn't happened in New Zealand yet, but of course it's taking a toll on lives as well, which is the health has got to be the first priority and thing we talk about.
Yeah.
But there's no doubt this is permeating through and starting to really
affect financial health as well.
Yeah.
Yeah.
Yep.
And so before we get on to maybe talking about interest rates and how that can all get through this period of time, how that could change to get us through, and what are some of the mechanisms underneath that, let's talk briefly about as from an investor's perspective, not necessarily from a borrower's perspective, but an investor in the markets. You've got KiwiSaver or some other managed fund, for example. And I'm not going to go there in terms of, hey, what should people be doing, because we've covered that already. Even before this happened, we covered that.
Yeah.
But talk to me about some of the dynamics, because you touched on one of them, which is, hey, this virus actually has to stop the economy for a period of time, for a time times and half a time, and then hopefully it'll be resurrected and off we go. Hopefully. But what kind of things are we going to see realistically? And obviously with their KiwiSaver balance, what are we going to see there? But
I think KiwiSaver is a good place to start. One of the things to bear in mind for KiwiSavers, if they've been in since the beginning in 2007, they've been through this sort of thing before. The global financial crisis.
They have actually, yeah.
And even 2018 gave us a mini taste when markets dropped about 20% at the end of the year and then recovered quite swiftly. The big difference this time around is in 2007, 2008, 2009, people were starting out with a zero balance, and their contributions and their employer contributions and the government contributions were making their balance go up. So even though share markets might have halved over the course of a year, their balances were probably going up pretty nicely. This time around, people have built up decent balances. So when markets go down 20, 30% like they have done, for people that are in, say, a growth fund or even a conservative fund, they will see those movements in their balance. And they didn't see that back in 2007 because their balances were so small.
Correct.
and
Correct.
proportionally growing because of their contributions.
That's right.
So this is feeling new for people, and it's triggering off concern. I mean, no one, me included, likes seeing their retirement nest egg go down. And but if I think about advice, which is what people want, it really comes down to people's individual circumstances. I mean, I'm with all my grey hair, I'm within a decade or so of wanting to retire, but hopefully within 20 or 30 years of needing all that money. If I cast my my rear vision mirror view back, in 30 years, why wouldn't I expect to see quite a lot more volatility? It's normal over a 30-year period to see quite a few upheavals. Look at the last 40 years, right? Since 87 to today. Yeah, at least 4. Right?
That's
right. So to a certain extent, although it's really uncomfortable, this is normal. The people that it's really hard on, people that are, say, saving for a house and they're seeing their balance move around quite a bit, or people that are well into the income phase of their investment lifetime, and it's nerve-wracking.
Yeah.
And my father's in this boat. He doesn't feel anywhere near as good about his expenditure outlook when he sees his investment balances changing around quite a bit. Now that's an understandable wealth effect, or if you like, or poverty effect. When you think, hey, my nest egg is getting small, I'm even more worried about how long it's going to last.
Yeah.
So the advice that people have really depends on their circumstances and their time frame.
That's right.
But I think one of the common themes is it's not a great time to change a well thought out investment strategy just because markets are choppy. And in fact, it's one of the things that people find quite alarming when they talk to us, is that our advice doesn't really change at times like this, because essentially, if we're talking about a 30-year time frame for someone's savings, we have to expect things like this. I just haven't found a time in history where I've liked all the presidents of the states, all the government decisions in New Zealand, and markets have just been plain sailing all one way. Yeah. It just happens that markets are choppy, but we know the right places for people to be invested for various time frames. But sticking on those tracks is one of the things that, as investment professionals, hopefully we can help people do it at times like this when the headlines can be pretty alarming.
And if you can't handle it, don't freak out now, but when this storm passes, and it will pass, maybe you should think about changing the type of fund that you're in the future. Because clearly, if you're really struggling and if it's giving you that much anxiety now, maybe you're not the type of investor that you thought you were.
Yeah, I mean, there's two things, and I'm subject to this as well. You can have all the investment theories in the world, but you've got to pass the sleep at night test as well.
Correct.
You don't want to be lying around at night worrying.
Yeah.
And really feeling like this stuff is stressing you out. That's not healthy either. So for all the theories in the world, that's an important test too. And I think that's where at any time in an investor's life, it's good to have good contacts and good sounding boards to check out your decision making and get good advice.
Yeah, advice absolutely key. Stick to the objectives, not to the circumstances. And term deposits, right? That's kind of where you'd want to be if you want a really pathetic rate of return, but really the better rate of return that you're going to get outside of savings is your reward to withstand what we're going through. It's compensation.
Absolutely, and it's amazing how much things change. A year ago, the standard complaint was these term deposit rates are lousy, and that's understandable. They're the lowest they've been since the 60s, and what else can I do with my money?
Yeah.
Now people are just thinking, I
want a term deposit.
I want a term deposit. I'm not concerned about return. I'm concerned about the return of my capital.
Correct.
And so people change drastically.
Hey, this is a question that I've been getting a lot, and I'm pretty confident in my answer because I've checked this and I've thought about this really carefully. But I get this question a lot just around term deposits and or savings in the bank. Are people safe?
Yeah, that's a good question. And one of the things we had in the global financial crisis, like all the developed world, was we got deposit guarantees, and then they got removed once the danger passed. So that's reasonably normal and was probably a pretty good strategy, apart from the fact that no one else in the world did that. Yeah. So we get a lot of questions about that and open bank resolution. Yeah. Really the place to look for confidence in the banking system is the Reserve Bank of New Zealand. They carry all the credit ratings of the bank. They carry out the financial stability review and talk about the things which they worry about.
Yeah.
Times like this are tough on banks and tough on customers, but we're lucky to be in this part of the world where we've got a very sound banking system, a really solid government, a really transparent and understandable Reserve Bank. So I think there's a lot of information people can read to get some comfort in the banking system.
And it's been bolstered up in the last couple of years, especially the Reserve Bank has kind of been almost, in a sense, it's almost like they knew what was coming. I guess they've been trying to build even more and more strength.
I think the Reserve Bank's really pragmatic. I mean, things have changed a lot, and the banking system's a lot more robust than it was in the global financial crisis, and that's all around the world. But I look at things like the loan lending restrictions, where loans have to have a lot more equity in them now than what they did in the past. Yeah. There's no such thing as a low doc or no doc loan or
110% loan.
Yeah, or adjustable rate mortgages where you're paying next to nothing and then suddenly you plunge into these much higher terms. Basically, the things which happened in the American housing market, which triggered the global financial crisis in the first place, just aren't present in our banking system. But that's not to say that times like this aren't incredibly stressful, but look at the course of this week. The Reserve Bank has said we're cutting their cash rate to 0.25%, which is what they regard for now as a floor. And here's the next cab off the rank. We will look to buy government bonds if necessary to keep interest rates low in the economy. Today they were out with liquidity measures to support.
Yeah. This is really interesting. So talk to me about some of the conventional tools. We know that last time it was 8.25. That's what the cash rate was when we were heading into the GFC. Now we haven't really even felt the full force of what's coming, and the cash rate's 0.25. So obviously there's a floor as to what the cash rate could go down to. It doesn't feel like negative interest rates are that much of a possibility. Correct me if I'm wrong. but more likely we're going to be going unconventional from here. Is that right?
Yeah, well, that's what the Reserve Bank's signalled. I think at a basic level, it's worth thinking: what are the Reserve Bank's two basic roles? One is price stability, which is what we often talk about. They effectively set interest rates to try and get an inflation outcome within the economy. I think generally they'd like inflation to be around 2%, and they want to manage the interest rates in the economy so that we get a growth rate that generates that sort of level of inflation, really at a very simple level. Their other role is financial stability. That's regulating us banks, that's making sure the system's sound, that's making sure people have got confidence in money.
Yeah.
It's boring stuff like printing coins, although not always boring. Sometimes they make some pretty neat commemorative coins for geeks like me. But they've worked hard on both tools, right? Everyone talks about the official cash rate being a bit of a blunt instrument, and the Reserve Bank's done a lot of other work over the years. You know, they've got tools to intervene in the currency market if they think that's useful for the economy and achieving their goals. They've got those lending restrictions. Those are not about making sure the housing market goes up at a certain percentage per year. Those are all about making sure the system's sound and that we've got quality loans on our books with equity in it. These new capital requirements that incidentally they're delaying the implementation are about making sure that there's plenty of capital behind any lending that banks do. So these are all things to try and make the system robust.
Correct. And
so there's been an awful lot of work on that front. And you know, the Reserve Bank tries to make it as easy to understand as possible, which I really tip my hat to them too. It's hard stuff to understand. But at times like this, it's really important. You know, things like the deposit guarantee. When I look back to the global financial crisis, they felt like at the time they were just patched together over a weekend. They were so quick to have to put them, because the global financial crisis was really unraveling at quite a pace. Now, when I look at the system, you know, these measures that we've got have been put into place after careful consideration over years and years and years. And so it's good to see how they all work, and times like now they get really tested.
So, and you mentioned the macroprudential regulations, the loan to valuation restrictions, the LVR rules that we've had in place now for a while. And most of us just think, that's to control house price inflation, and maybe there's some truth in that. But like you say, like the real reason is to encourage strength in the banking system, just like the capital reserve requirements are there to do that.
Absolutely. I mean, the Reserve Bank doesn't have a goal for house prices.
It's not their mandate.
No. Their goal is about financial stability and that price stability. So they're concerned about house prices and asset prices as they relate to those goals. And so at times like now, when they're looking to make adjustments, it's about supporting the economy, but within the framework of those mandates. And it's important to remember, you know, so everyone has their role to play, and monetary policy has a role in a crisis like this. And we learnt the lessons in the global financial crisis. If you lower interest rates, that can help cushion the blow at a time like this to the economy.
It's the insulin.
But the other side of it is you've got the availability of money.
Correct.
So making sure that there's liquidity in the system.
Because it doesn't matter how cheap it is if you can't get it.
Exactly. And so that's important. And that's where all those measures to make sure the banking system is sound are so important. So I feel like the banking system's just a different place now compared to 10, 15 years ago.
We've got a war chest, don't we?
That's right. And if there's a lesson from the global financial crisis, it's that policy works. Monetary policy, so what the Reserve Bank does, and fiscal policy, what the government does. And that's what we're seeing in play right now. You know,
both those levers are being pulled.
They are not holding back.
That's right. So let's talk a little bit about fixed interest rates for a little bit. A lot of our audience will be property investors, or they'll own their own home and have significant amounts of debt. And that contrasted with their expectations around income in the next 12 to 18 months in particular, that's going to be front of mind right now for a lot of people. at time of recording, we're seeing interest rates just a smidgen above 3%.
Yep.
Record low fixed interest rates, unbelievable.
Mm.
What will stop them from going even lower in a normal situation? How does that work?
Well, normally when you see the official cash rate get cut, that doesn't impact the funding for all borrowing. It's a starting point. But typically when you see it get cut, very short-term rates like the floating rates adjust almost immediately. People need to remember, though, that behind a long-term interest rate, or if someone took out a term deposit or a mortgage a couple of months ago, those two things were interacting to set the rate at the time. So right now, whether mortgage rates for, say, a 3-year fixed term can fall is not really a function of what the official cash rate is. It's influenced by what we think it'll be over the next 3 years, but it's also heavily influenced by what does it take on the term deposit side of the equation.
Yes.
So banks have to balance both of those things up. Now, typically when the official cash rate's down and is expected to stay low, you see downward pressure on both. And indeed, that's what we've seen over the last few years, right? Is that both have come down. So term deposits and mortgages are both a couple of percent below the average sort of levels that we'd expect over the last 10 years. So your mortgage rates. I mean, I remember getting one 5.7%, and I thought I was getting a bargain.
You were, man. You were.
And now I'd think my throat was cut if I had to pay that again, right?
Yeah.
And here we are with them getting even lower.
But what you're saying, just to clarify, is that with a fixed rate loan, or with any lending for that matter, to a certain degree, the rules are that a certain percentage of that has to come from the bank's balance sheet. It has to actually come from somewhere.
Yeah.
And therefore term deposit rates are really important.
Every cent behind a loan needs some sort of return. So there's an aspect of bank's capital. Think of it like the shares in the bank, which in ASB's case are owned by our
Commonwealth Bank.
parent,
Yeah.
Commonwealth Bank. The return on capital is the most expensive. It's the riskiest part of a loan from the bank's perspective, their own capital, and then at the lower end of the risk scale is a long-term deposit. Someone that's happy to leave their money with the bank for 5 years, at the moment about 2.5%.
Yeah.
So all of that flows through to the overall cost of the loan, but there's a return requirement on every bit, and so right. Banks have to balance up all of those things. The lower is better as far as a borrower is concerned, but it's the opposite from a saver's perspective.
Correct.
So that's why you don't see fixed rates move in lockstep with the declines in the official cash rate.
That's right.
But they generally move in the direction. I mean, if the Reserve Bank was saying, "Hey, we think we're going to be hiking rates in 6 months' time," we'd be seeing people factor that into their expectations and want higher returns. They're saying the opposite. The official cash rate's going to stay low for the year ahead. The other element in it, and I think this is important for borrowers, it's not just about the cost of money, it's the availability of money. So when an economist's saying, or when the Reserve Bank's saying, hey, the official cash rate's going to be low for a long time, that doesn't mean just be complacent and don't worry about it. These are the sorts of times where you want to make sure you've got your finances sorted out and access to the lending that you're going to want to do.
Yeah.
And likewise, value the certainty that you can get at incredibly low costs right now.
That's right.
I mean, if we'd sat around 10 years ago and I'd said, hey, we can get a mortgage for 3.9% and lock it in for 5 years, what would you do? You go, I'd take that. I take it every day of the week.
That's
now
right.
that they're down there, people are going, oh, should I hang out a little bit and see if they get a bit cheaper?
That's right.
And we're in the middle of this quite stressful situation.
Yeah.
You know, people, I think...
I know. A 5-year rate right now, 3.79, for example.
Yeah.
Why not? Like if you had confidence in your income and you wanted to really lock things down,
you can get a lot of certainty for an incredibly low rate. Look back at some of the periods in the 2000s when the central banks were trying to slowly raise interest rates.
That's right.
Things move quite quickly. Not when the first official cash rate hike comes.
Yeah.
But when markets start to anticipate that,
Correct. So that was around 2011, I think.
Yeah, we
somewhere
saw big movements in mortgage rates over that period of time because market conditions changed in a favourable way. People were expecting, hey, central banks are going to want to return policy settings to normal.
Correct.
I want to beat the rush, and in doing so, created a rush.
That's right.
It was like what was going on in the mortgage world was like what's going on in the toilet roll aisle at the moment. Everyone was rushing to get in while they could. It was bizarre, and so I guess my message is don't just sit around and think, hey, it sounds like rates are going to stay low for ages. Understand what's going on, and get your ducks in a row, which is the advice I'd give to anyone at any time.
That's right.
But I wouldn't get complacent just because the Reserve Bank's saying, hey, we expect interest rates to stay low for a while. I'd keep abreast of what's happening in mortgage markets.
Be aware of the short term, plan for the long term.
Yeah.
So let's talk about some other unconventional ways, though, that things could change. Like, let's just assume that the Reserve Bank decides to pull out some other unconventional tools. What would they look like? Specifically, I want to go down the path, I guess, of mortgage-backed securities and how that kind of works.
Yeah.
Is that okay?
Yeah. Well, so in the first instance, what you see is, I guess you could call it open mouth operations.
Yeah.
Central banks talk a lot about what they're going to do in the future,
Jawboning,
what their next move might be. And that's happened in this case, in that the Reserve Bank said, here's what we'd do next. They've told us the official cash rate is going to stay low for the year ahead.
Correct.
And if they need to do something else, it would be in the form of some sort of long-term asset purchase program. So think going out and buying government bonds because they want to hold those yields down.
Okay.
There's another aspect that they've announced this week, which is more about liquidity, actually.
Okay.
Is just making sure that those bond markets are functional, and swap markets and other markets. The foreign exchange market would be another one that they might be interested in its functionality rather than any particular level.
Okay.
But the idea of asset purchases is to try and anchor those long-term interest rates at lower levels.
So define, just for our listeners, define what you mean when you say asset purchases.
So in this instance, would be talking about government bonds.
Yeah.
That would be the first thing.
Yeah.
So say a 10-year government bond is what I'd regard as the long-term risk-free asset within an economy.
Yes.
But everything builds off that, right? So what an investor can get in a government bond, let's say they said 1%, would like to cap those yields at 1%.
Yeah.
In Japan's case, they said 0.
Yeah.
We want to keep long-term government debt yields at 0. Yeah. Well, then if someone wants to take a low level of risk beyond that, say something like a council bond or a little bit more, a corporate bond, well, those yields would have some sort of build on top of that low rate that the Reserve Bank was a risk premium, that they were trying to anchor the government bond yield at. So that's one aspect of how they would try and influence interest rates in the economy.
Right.
Now, that would impact what a corporate could go out and raise money at. It would impact what the government could go and raise money at. And that's important at a time like now where the government's going to want to issue more bonds.
Yes.
That's a little bit different from when a market's stressed or a little bit dysfunctional, because there's not enough liquidity in it. There's a whole lot of sellers and not a lot of buyers and that sort of thing. So don't get so it's important not to get those two mixed up. But there's other things that they may want to achieve. If we look at central banks in other parts of the world, when they've wanted to get fresh lending into the economy, things like buying mortgage-backed securities. So this is essentially buying a whole lot of mortgages off banks, so that those banks in turn have got fresh money to go out and lend into the economy. So that's about two aspects. That's about the interest rate in the economy and the money in the economy.
Yes.
So
that's right.
I think the key message here is that we typically just see that conventional tool of what the official cash rate is, but there is a lot of stuff that the central banks can do. We've seen it in Europe, Japan, the US, the UK. We're going to see it in Australia, and possibly we'll see it in New Zealand over the course of this year if needed. And the way things are moving, we might be seeing it by the time people are listening to this podcast. But the Reserve Bank's been pretty clear that they've got plenty of tools left to use, and they're not afraid to use them, which is I think is a good signal.
And if you're a bit of a Reserve Bank geek,
guilty as charged.
That's right. And like a lot of people in the Reserve Bank themselves, they're into this stuff, and that's cool. And they're really smart people.
Yeah.
Like in a sense, they've kind of probably always been dreaming about what would they do if. And so this is actually really cool because now, because of that independence thing going on as well, we can actually start to see this happening. It's encouraging, I think. It's good news.
Yeah, and it is fascinating. I mean, I look at periods in my career where the official cash rate's been on hold for years, and you sit there and every 6 weeks you write up, we don't expect to change. Then after the meeting, they didn't change as we expected.
Right.
Whereas things like this, there's just so much to analyse and understand.
Correct.
And this is another thing that I think is really encouraging is most people haven't had to worry about this stuff, but the Reserve Bank's been talking about what they could do for a long time, so they're not making this stuff up on the fly. This is well thought out.
It's cool,
This is well thought up stuff, including things like the open bank resolution that people fret about.
Do you want to define that just for our audience?
So this is what people talk about when they say, "Hey, what would happen if the banks had problems? Would I lose some of my term deposit?" That's a pretty well thought out policy, and there's a lot of information to read about it. The problem is that that we're alone in the world, and that most of the other banks kept their guarantees that they put in place in the financial crisis. But they're incredibly well thought out policies, and they're pretty easy to get explanations for why they're there. And as we see things changing like they are now, the Reserve Bank's communication's been pretty good about what they're trying to do to make sure the system keeps working.
Okay, so I know with a lot of what you're involved in with ASB, you're writing a lot of commentary with the podcast that you're involved with as well. A good chunk of that is trying your best to take current data, current events, and cast them into the future to construct a vision of what you see potentially coming up. So if we were to think 1 year, 2 year, 3 years in advance, again with the benefit of hindsight following the GFC, what do you see potentially unfolding here?
Okay, well, essentially what economists do is try and model things. So we've got people in our team that are just exceptional economists modelling the economy, and when news comes out like we're going to close the borders, we've got models which show how much tourists spend in New Zealand and the pulse that they cause. So at times like this, we can rerun our models to go, right, what does it look like if we change that dynamic? So we're modelling how this impacts the economy as it unfolds. Now, at the start of the situation, we were looking at, okay, what does China shutting shop for 6 weeks look like for our exports and our imports? And so we're really looking at supply disruptions. So and we thought, okay, and then the Chinese tourism ban, which is, a lot of tourists can't come here. So our first round of modelling was, right, let's cut our forecast to relate to that. And so we came up with a forecast that the economy was going to be flat for the first quarter, and then a lot of activity would bounce back in the second quarter. As it spreads and the stories change and the inputs to our thinking change, we just constantly rework it. So clearly what's happened over the last 6 weeks is our modelling's changed from a short, sharp shock, which is what even the Reserve Bank was talking about in mid-February when they kept the cash rate on hold back then at 1%, into, right, this is going to impact for longer. This is going to be impacting us for at least the course of this year. And so at the opposite end of this scale, we start to think of things like, okay, how long is the best information telling us it's going to take to make a vaccine? What is people's behaviour going to be like once they know there's a vaccine? And here's where the think tank, if you like, comes in. In my instance, I think, hey, this seems really scary, and people say, hey, travel will never be the same. But it felt like travel would never be the same after the terror attacks. But once we felt safe that wasn't going to happen, we resumed our travelling ways.
And I might just interject here and just point out, I really wish I could find this article. Possibly it's been taken down on purpose, but around about 2010, I think it was, one of the bank economists, it wasn't you, don't worry, went out there and said, the property market will never, ever grow at double digits ever again.
Yeah.
Very definitive.
Yeah.
And it it did change. So there is a limitation as to what a mathematical equation can forecast. Right? You're a scientist, basically.
And absolutely. And I think if you hang around as long as I have, you get good at saying, I don't know, but here's some things which is guiding me to think this.
Yes.
So back to your question about how things fold out. I mean, essentially we go, what is our core view on things? And then when you go, well, a lot of people like, oh, what's a good scenario and a bad scenario? And really in this situation, the good scenario is it doesn't take as long as we're expecting right now. Yeah. And the bad scenario is it takes longer and the economic impact's deeper. What we also want to do is be able to carefully evaluate what responses are going on and what they are trying to achieve. And people get a little bit mixed up on that.
Right.
The government in their first instance was trying to cushion the blow and have a real focus on health outcomes. Their other objectives that are coming out now is how they're going to support big industries that are impacted like this, like details of the aviation support plan, that sort of stuff. It changes the dynamics for their budget coming out. Yeah. So we try and analyse those things and whether they're going to achieve their goals and what it's going to mean for economic growth. Yeah. And again, we're just people that are trying to run it through our economic forecasting system.
Correct.
In a pragmatic way. But we look at other economies and things that work and things that don't work. We try and think of some of the unintended consequences of policies and some things that just create a lot of bureaucratic work. And that's what you get in things like our economic forecasts that we seem to be updating reasonably regularly at the moment.
Yeah.
But the goal for us as bank economists is to try and provide useful information for our customers to make decisions on.
Yeah.
In my case, it's trying to give information for people to make sound decisions about their investments. Yeah. And the other team members, it's trying to make good decisions about how this situation might impact their business. But that's always our goal, is to help make good decisions in all times.
Yeah.
But it feels pretty important at times like this when so much stuff is changing.
Yeah. Awesome. There's a prick for every bubble, isn't there?
I guess so. I mean, the one thing I remember when I started out, I worked for a really interesting economist called Chris Caton at Bankers Trust. And he said the one thing we know about bubbles is they always burst. Yeah. We just don't know when.
Correct.
And what's a bubble at the moment is tricky. I think more of now what people are prepared to pay for assets changes drastically when they're uncertain about them. I mean, the share market looked expensive six or 8 weeks ago, but not if the best you were going to get on a term deposit was 2%. I mean, there's a number of companies in New Zealand paying really strong dividends in the economy that we foresaw that were pretty appealing when as an alternative to the very low interest rates that prevail.
Yeah.
But now the outlook for those companies and the people's appetite for risk changes so much.
Correct.
So I don't sort of think there was a share market bubble in this burst. I think the value people put on certainty or uncertainty, the risks that people are prepared to change drastically at times like this, and that causes some pretty wild movement in asset markets like we're seeing.
Repricing of risk,
and you just see a lot of people that think, I just want my capital back.
Correct. That's right. This kind of like, I will sell it at any price, I don't care, I just want to get out.
Yeah, and that's understandable from an emotional sense, but it can be pretty destructive from an investment perspective. And as I was mentioning earlier in the podcast, this if you're investing for the next 30 years, this will be hopefully it'll be one of the worst downturns you have.
Yeah.
30% drop in US shares is a really big deal.
Correct.
But you'll see plenty of volatility over the course of the next 30 years, and you'll see plenty of things going on in the world that aren't particularly pleasant. That's just the way it's been for my entire career, that every few years something comes along to really rattle us, and I'm sure it'll be the same for the rest of it.
Okay. So, bringing this all in, wrapping this all up, and coming in for a landing, every other analogy I can use, as a response to what's going on right now, just a couple of lines, what should people do right now?
I think for investors, if they've got well thought out plans, they should aim to stick with them.
Yeah.
If circumstances are changing, then obviously get some advice.
Yes.
And there's going to be stress in the system for people with loans. And wanting to understand how the mortgage market's operating, keep close to their banks. And banks are going really hard to get out a lot of information and be patient. I think one of the best things I got was from Air New Zealand saying, if you're not flying within 48 hours, please don't call us. And be realistic about the workload that people are under. But seek out that advice and help if you feel like you need it.
Yeah.
And banks, investment providers, mortgage providers are trying really, really hard to make sure that there's a lot of information available for people so that they can make sound decisions.
Yeah, the good thing about this crisis is that we're all on the same team. It's not like it's just happening to a small group of people.
Yeah.
We're all going through this. And we're all worried, so it's like
and I no matter what your political stripes are, I think the Prime Minister here gave us some pretty good advice to get onto the official website. That would be where we would find out information.
Not Facebook.
Not Facebook. There's been some pretty lousy stares about what's going on in social media. So I think stick to the facts from the government, from the health organisations, and try and get some good information from your product providers, whatever those products are, about how things are going and what the advice is.
Cool. Awesome. Really want to thank you, Chris, for coming along. So Chris Tennent-Brown, economist at ASB, thanks for joining me today.
Thanks, Darcy.
All right. Have a good day.